Okay, investors, before getting into this week's topic, which is making front page financial headlines week after week, that's the AI technology capital expenditure tsunami, the team here hopes you had a peaceful and thankful Thanksgiving yesterday. So over the past 10 years, the stocks of the 7 large technology companies, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, have performed so well and grown by such big size, they've been grouped into a universe known as the Magnificent Seven, or Mag 7 for short. So the Mag 7 stocks as a group have significantly outperformed the rest of the S&P 500. Investors, since 2015, these 7 stocks have combined to return almost 27.5% per year, largely due to the extraordinary high revenue growth, high margins, and high operating profit per employee on the back of being relatively asset light. However, recently, the Mag 7 cohort has ramped up capital spending significantly, and this spending habit shows no sign of slowing as they're projected to continue to spend aggressively on semiconductor chips, racks, servers, and electricity and real estate into the near future. Investors, as they spend more, they shift from asset light to more asset heavy, and the risk of overinvestment and lower marginal return on invested capital grows with it. Meta, Microsoft, and Alphabet are each set to spend between 21 and 35% of their revenue on Capex in the next few years. Combined, the 7 are estimated to spend almost $400 billion per year the next few years. If Jensen Huang from NVIDIA is correct, that number might be closer to $500 billion per year. Big tech's AI spending is currently so large that it's helping the broader economy, accounting for an estimated half of U.S. GDP growth so far this year. Per the Carson Group, a chart on incremental GDP from tech spending. Investors, you can see this spend level is now currently above incremental GDP contribution during the late 1990s dot-com Capex boom. So why the recent concerns? Well, past infrastructure spending booms have taught investors that the path to sustainable revenue is often set by periods of overinvestment and poor returns, so-called booms and busts. Whether it was the railroad build-out in the early 1900s, car manufacturing boom after World War II, the initial boom in personal computing penetration in the late 70s and early 80s, or most recently, the dot-com fiber capacity build-out in the late 1990s, or even more recently, electric vehicle boom post-2010. According to Mary Meeker, who sat at the center of the dot-com boom, generative AI penetration is reaching prior penetration rates at an unprecedented pace. ChatGPT hit 800 million weekly active users in just 17 months. Meeker said it took the internet nearly 25 years to get to that many users. PCs took 20 years to reach half of US households. Desktop internet took 12 years, and mobile internet took 6 years. And AI appears to be reaching 50% penetration here in the United States in just 3 years. Investors, here's a great graph from Forbes for prior technology advancements and their adoption curves over the last century. These build-outs and technology advances provide examples of capital investment cycles. Initially, the excitement around new technology spurs firms to make massive capital investments. Investors reward these accelerating outlays with soaring stock prices, encouraging even more investment. In the late 1990s fiber build-out, telecoms and startups laid 80 million miles of fiber optic cable. Unfortunately, over the next 5 to 10 years, 85% of that cable laid unused, and the cost of bandwidth transmission on these lines fell by minus 90%. User demand didn't keep up with the new supply coming online, and that caused prices to crater, saddling the industry with years of excess capacity. Corporate values collapsed, and those that took on debt to finance the build-out, many had to file for bankruptcy. However, that minus 90% reduction in fiber costs fueled successes of others like Google's YouTube, Netflix, Facebook, whose business models flourished on the back of plummeting internet transmission costs. Investors, up until about 2 months ago, 2025 investors looked at these accelerated AI Capex investments favorably. However, recently the tone has changed amongst a flurry of debt-financed expansions, off-balance sheet commitments, and unfinanced gargantuan Capex future spending plans by OpenAI and others. While the topic of accelerating AI Capex spending from a sustainable return on investment capital and accounting treatment standpoint has been discussed throughout the technology investment circles for 2 to 3 years now, the last 4 to 6 months, and the voice and social platform of investor Michael Burry have recently brought the accounting discussion to the forefront of many investors' minds. Here's the progression of the depreciation schedules for a few of the Mag 7 from public records as compiled by Mr. Burry. This topic currently sits in the crosshairs of short sellers and those currently negative on AI spending. As one can see, in general, all of these companies have lengthened their depreciation schedules the last 5 years, some nominally like Oracle, others rather substantially like Meta, Google, and Microsoft. Investors, while this does little to change a company's free cash flow, it does have the effect of increasing their reported earnings as depreciation is a non-cash charge on the income statement. Depreciation charges try to estimate the useful life and value of longer-lived fixed capital investments. Burry's argument is that these companies are overstating earnings significantly because as opposed to longer useful lives, lower depreciation per year, NVIDIA's accelerated product cycle is obsoleting old chip generations faster, not more slowly. This issue is increasingly important as Burry is correct in that each recent NVIDIA chip cycle has been produced faster than the previous. And now, in the 2025-26 passage of the Big Beautiful Bill, in its accelerated depreciation provision, financial need motivates companies to invest faster, reduce taxes, and reach profitability sooner. The new BBB depreciation rules allow front-loading of AI infrastructure Capex depreciation in year one. This helps the financial profile of the AI build-out as it allows front-loading depreciation, which does lower GAAP earnings in early years, but it frees up cash flow by reducing taxable income. This is a super interesting discussion and yet very fluid in concept because mathematically, in accounting, depreciation is linear, while in the real world of computing, more specifically, artificial intelligence, demand creation is growing exponentially. One doesn't have to look far to see what I'm talking about when industry insiders think about demand. At a November 6th meeting, a vice president at Google Cloud told employees that the company has to double its serving capacity every 6 months in order to meet demand for artificial intelligence services. Google raised its capital expenditures forecast for the second time this year to a range of 91 to 93 billion, following a significant increase to come in 2026. I don't have the answer to the question that Michael Burry and others have recently raised on depreciation schedules and useful lives of NVIDIA chips. I can only relay what those closer to the AI nucleus have relayed to me. On chip useful life, those I've talked to say the industry is still getting function and value out of much older chips. NVIDIA technology that is 5 years old is not being used for new leading-edge world models or deep neural networks. Instead, those chips and systems are being used for less data-intensive tasks that are closer to the end client. Think about general search or data retrieval queries that most consumers use regularly. Burry called the Mag 7 accounting fraudulent, which kind of strikes me as an overly aggressive position. Nick Rake, CEO at the Earnings Scout and former head of earnings department at Zacks Research during .com time period, has expressed his opinion that while aggressive, the depreciation issue we're discussing is neither a crisis nor at all comparable to Burry's prior mortgage market security success. Investors, year to date, the Mag 7 stocks raised capital spending by over 60% in 2025. Because of strong revenue growth, year to date, net operating cash flow grew by about 21.6%. However, net free cash flow, because of the Capex tsunami, the Mag 7's free cash flow turned negative in recent quarters. This negative free cash flow situation also occurred in 2022 when Meta took an unprecedented upfront spending on the metaverse bets, just as TikTok and short-form video format is picking up steam on the advertising revenue side, taking market share from previous social media leadership. Investors, many are worried that like Meta's ill-fated Capex investments and bets on the metaverse in 2022, most of which have yet to generate substantial revenue, Mag 7's current AI spending boom will be money out the door with an indeterminate time and level of investment return. That their marginal return on invested capital on all this spending will be substantially less than their current asset-light models, or worse yet, very little or no extra revenue, and take their marginal return on invested capital in the wrong direction over the coming few years. Lower, not higher. With all this said, investors and followers know that regardless of the outcome in this AI investment tsunami, our entire Oak Harvest team will be here for our clients, doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement. them.